Silver LF, the country's only pure-play silver fund, halted trading for the second time in 4 days. And this time, they're not letting new money in. The manager issued an emergency notice saying subscriptions are suspended indefinitely. And even if you already own shares, you can't add more funds, even if you're begging to. But that's not the part that should scare you. The part that should scare you is what's happening 73 kilometers south in Shenzhen's Bay Jewelry District. Because right now, 352 people are standing outside a silver dealer's office waiting to be compensated after the company defaulted on deliveries last week and then stopped answering phones. And across the street, 6 jewelry manufacturers, companies that have been making silver rings and necklaces for 30 years, just announced they're shutting those production lines down permanently. Not slowing down, shutting down. And they're retooling their factories to make investment bars instead. Why? Because they can't get raw silver at any price anymore. This isn't a normal pullback. This isn't a healthy correction. This is panic. And I have the documents that show exactly what triggered it and why every expert who said silver would cool off after hitting $70 in December got it completely wrong. The trading halt notice from UBS's SDIC Fund Management went out at 11:49 a.m. Beijing time yesterday. And the wording is unusually blunt for a Chinese financial institution. Quote, "In order to protect the interests of fund shareholders and prevent risks caused by irrational trading, our company has decided to suspend large subscriptions and conversions for Class A shares and suspend all subscriptions and conversions for Class C shares of this fund starting January 29th, 2026. Here's what that means in plain English. They're scared. They're scared because by January 24th, the fund's market price had inflated to 62% above the value of its underlying assets, a 62% premium. That means investors were paying $162 for $100 worth of silver futures exposure just to get their hands on anything tied to the metal. And when a fund trades at that kind of premium, when retail demand is that desperate, the fund manager knows what comes next. A premium like that can't stay up forever. Either the underlying silver price rises hard enough to justify it, or the fund price collapses back down to reality. And on January 25th, reality hit. The fund dropped 10% in a single day, hit the down circuit breaker, and then fell another 10% the next day. That's a 20% hit in 48 hours for the people who bought at the top, and now the manager is basically saying, no new money, we're protecting you from yourselves. But here's what makes this insane. Despite the crash, despite the warnings, despite the manager practically pleading with people to stop. When trading reopened on Monday, January 27th, after a 1-hour emergency suspension, the fund slammed the upward limit again, limit up, a 10% gain in a day, the maximum allowed under Chinese rules. So in 5 trading sessions, it went limit up, then limit up again. That's not investing. That's roulette. That's fear. And the Shenzhen Stock Exchange knows it. They issued a formal notice on January 24th saying they were placing the fund under special monitoring for activity from December 24th through January 8th. And according to screenshots circulating on Chinese social media, which I verified through 2 independent sources, some investors received broker messages warning that abnormal trading behavior in this fund could lead to accounts being frozen or restricted. Think about that. The exchange is essentially threatening to lock people out of their brokerage accounts if they keep panic buying silver. That doesn't happen. That has basically never happened in modern Chinese commodity markets. And it tells you exactly how seriously authorities are taking this. Now let me show you what's happening on the ground in Shenzhen, because this is where the panic stops being a chart and becomes real life. Shenzhen is home to China's biggest physical precious metals marketplace. The Shui Jewelry District alone processes over 30% of China's gold and silver jewelry. It's the heartbeat of the industry. And according to a report published by National Business Daily on January 26th, a major silver seller in Shuit defaulted on physical deliveries in mid-January. Here's what happened. The company took payment from 352 customers for silver bars and coins, promising delivery in 7 to 10 business days. Customers paid, the company took the money, then the company admitted, we don't have the silver, we can't fulfill the orders, we're working on compensation. So now, 352 people are waiting, and follow-up reporting says the company has gone silent. Phones aren't being answered. The office is locked. This is a straight-up default in the physical silver market. And it's not because the company was some obvious scam. It's because they literally cannot source physical silver at a price they can pay to deliver what they already sold. The metal doesn't exist at normal prices anymore. And this default isn't a one-off. According to the local industry association in Shenzhen, they issued a sector-wide warning as early as October 2025, referencing enforcement actions against 3 other companies for similar problems. And Bloomberg reported yesterday that authorities in Shenzhen's Luhu district have now created a special task force to oversee gold and silver trading platforms after multiple investors complained they couldn't withdraw funds from their accounts. This isn't rumor. This is institutional breakdown, when local governments have to form task forces to manage precious metals trading, when customers can't get their money or their metal, when defaults start happening at real dealers. You're not in a bull market anymore. You're in a crisis. Now, before I show you what manufacturers are doing next, I need to address something important because I'm seeing a lot of accounts pop up using similar styles and visuals to this content. So here's the chill guy way to handle it. If you want the real updates and the clean breakdowns, make sure you're following this channel. Hit subscribe and drop a comment so you're locked in, because the fakes can copy a look, but they can't copy sources, verification, or on the ground signals. Now back to the manufacturers. According to Trading Economics reporting from January 28th, citing Chinese industry sources, jewelry manufacturers in Shenzhen and Guangzhou, the two biggest processing hubs in China, have started shutting down silver jewelry production lines. Not cutting back, shutting down, and retooling those same factories to produce investment-grade 1 kilo silver bars. Let me explain why that is crazy. Jewelry companies make money on craftsmanship. They buy raw silver. They design it, shape it, polish it, add stones, enamel, brand value. A ring with 10G of silver can sell for multiples of the metal value because you're paying for artistry and brand. That model has worked for decades, but now these companies are saying, we're done with high-margin jewelry. We're switching to plain bars with almost no markup. We're going to compete on volume. Why would anyone voluntarily step down from high margins to low margins? Because they can't reliably get the raw silver to make jewelry in the first place. And even when they can source it, the price is so volatile and premiums are so extreme that they can't quote stable wholesale pricing to retailers. So they're pivoting to investment bars, because bars can be sold immediately to panicked buyers at spot plus a fabrication fee, lower margins, but instant turnover and guaranteed demand. And the data backs up that this shift is real. China's silver imports in October 2025, the most recent month with customs data available, totaled over 1,700 tons. That's the highest monthly import number China has posted in more than 5 years. And classification data shows most of those imports weren't industrial-grade silver and weren't jewelry inputs. They were investment-grade bars and coins. China is pulling physical silver out of global markets at historic speed. And it's going into private hands, not industrial demand, not jewelry demand, investment demand, hoarding. And manufacturers are chasing the money. They're saying, if retail investors want bars, we'll make bars. If they want coins, we'll make coins. But we're not making necklaces when people think silver could double again in 6 months. This is a structural break in the traditional jewelry supply chain. And it's happening at the same time as fund suspensions, dealer defaults, and government task forces. Everything is snapping at once. Now let me show you the mechanism behind all of it, because there's one policy change that triggered this cascade. And if you don't understand this policy, you don't understand why the panic is rational. On January 1st, 2026, China put new export restrictions on silver into effect. The policy reclassified silver as a dual-use strategic material, the same category as rare earths, and under the new rules, only 44 companies in China are authorized to export silver. 44 out of thousands that previously exported freely. And to qualify for one of those 44 licenses, a company has to meet two requirements. First, annual production capacity of at least 80 tons of silver. That instantly cuts out hundreds of small and mid-sized refiners and exporters that have supplied global markets for decades. Second, the company must have credit lines over $30 million. Again, a hurdle mostly only large state-owned or state-backed enterprises can clear. So, with one change, China went from a wide-open export channel to a controlled oligopoly, where only approved giants can ship silver out. And China isn't a minor player here. China controls a massive share of global refined silver supply, not mining, refining. They import concentrates from Latin America, Australia, and Africa. They refine in China, and then they export finished metal to manufacturers worldwide. That refining bottleneck is where the leverage lives, because you can mine silver in Peru or Mexico. But if China dominates refining capacity, and China now requires government permission to export refined silver, then China effectively controls global flow. And the policy that went live January 1st is already showing up in projections. China exported about 4,600 tons of silver through the first 11 months of 2025. In January 2026 alone, exports are projected to fall 40% to 50% based on industry estimates. That's roughly 2,000 tons per year removed from global availability. And there's no fast replacement. Refineries take years to build. Expansion takes years. So the silver that flowed out of China for the last decade is now being held inside China. And domestic use right now increasingly means investment bars for panicked buyers. This export restriction wasn't secret. It was announced in December 2025. But the impact takes time to show up because supply chains don't realize they can't reorder until they try. A jewelry manufacturer in India that used to buy refined silver from China monthly now gets told, sorry, we can't ship, no export license. So that manufacturer has to scramble for Switzerland, Canada, Mexico. And those sources are either sold out or quoting 15% to 20% higher prices. So they either pay up or shut down. And the ones shutting down are the jewelry makers. The ones paying up are industrial users, solar, electronics, EV supply chains, because they can't stop. They need the silver to keep factories running. But jewelry production can pause. And that's exactly what's happening across China, India, and much of Asia. Jewelry output is collapsing, investment bar output is surging, and the panic feeds itself. Now, I need your help. This story is moving fast and no one can track everything alone in real time. If you're in China or you have contacts in Shenzhen, Guangzhou, or the major manufacturing cities, drop a comment telling me what you're seeing locally. Are dealers still selling? Are premiums getting worse? Are more companies defaulting? Direct observations matter because official data lags weeks, sometimes months. The comments are how we crowdsource real-time intelligence. And if this kind of on-the-ground reporting is valuable to you, hit like, subscribe, and comment Chill Guy. So the algorithm knows this is what people actually want because the copycats can recycle headlines, but they can't build a real network and verify what's happening. Now, let's look at the numbers because the fund suspension and factory pivots are symptoms. The underlying disease is a supply deficit that's been building for 5 years and just accelerated into a January 2026 crisis. According to the World Silver Survey data published in November 2025, global silver demand in 2024 was 1.24 billion ounces. Total supply mining plus recycling was 1.01 billion ounces. That's a deficit of 230 million ounces. 230 million ounces that had to come from above-ground stockpiles held by governments, institutions, and private investors. And those stockpiles aren't endless. The survey data shows this is the 5th straight year of structural deficits, 5 years of inventory draw. Downs in those inventories are thinning. Comp's registered silver metal available for delivery against futures in New York has fallen sharply from 2022 levels to under 100 million ounces by January 2026. London shows similar declines. The physical float, the silver actually available for purchase day to day, is estimated under 100 million ounces globally, maybe even closer to 50 million ounces. That's about 6 weeks of global industrial consumption. 6 weeks. And if exports choke, defaults spread, and funds keep slamming the brakes, that float can vanish in days. And demand isn't easing. Industrial demand is speeding up. Solar alone consumed over 500 million ounces in 2024. And by 2030, solar plus EV growth is projected to consume more than half of annual global silver supply. That's not hype. That's physics and manufacturing requirements. Every solar panel needs silver. Every EV needs silver. Every smartphone needs silver. Every AI data center needs silver for power management and thermal control. And unlike gold, where demand is heavily investment in jewelry, silver's industrial demand is price inelastic. Factories don't stop buying because the price went up. They can't. They pay up and pass the cost forward. So the only way to balance supply and demand is to crush investment demand by pushing prices so high, retail buyers stop. But Chinese retail buyers aren't stopping, they're accelerating. That fund hit limit up again, even after warnings and crashes, because many Chinese investors watched real estate implode, watched equities disappoint, and decided physical metal is the only thing they trust. And when 1.4 billion people decide to shift even 1% of savings into physical silver, the market breaks, because there isn't enough silver on Earth to meet that demand at today's price. Now look at premiums, because this is where paper and physical split into two different worlds. Spot. The price? You see on Bloomberg, Kitco, and finance sites closed yesterday around $71 per ounce. That's the futures price. But if you want immediate physical delivery in Shanghai, premiums are now running 12% to 15% over spot. That's $80 to $82 per ounce for metal you can actually take. Tokyo dealers are quoting $85. Dubai around $84. Mumbai retail shops are effectively pricing kilos near $90 per ounce after conversion. Paper says $71. Physical says $80 to $90. That's a 15% to 25% disconnect, and it's widening daily. January 15th, Shanghai premium near 5%. January 20th, about 8%. January 25th, about 12%. And yesterday, January 28th, multiple Shanghai dealers quoting 15% premiums for immediate delivery. That's the market screaming, there isn't enough physical metal to satisfy demand at the paper price. Paper is the story, physical is the truth, and the gap between them is the panic premium. So what happens next? There are three possible routes from here, and every route stays bullish long term. But the path is different. Path 1, government crackdown. Authorities see the frenzy. Fund halts, defaults, lines outside offices, and decide it's out of control. They add controls on silver purchases. They cap monthly buying. They restrict online silver funds. They punish investment advice accounts. China's done this before with other assets. Crypto in 2017, property speculation in 2021. They could do it with silver in 2026, and if they do, demand doesn't vanish. It goes underground. People buy through gray channels, buy offshore, move through Hong Kong, Macau, Singapore. Demand becomes harder to measure, and supply pressure gets worse. Path 2, industrial allocation. Beijing decides retail hoarding is consuming silver industrial production needs, so they impose an allocation system. Industrial users get priority. Refiners are told, you must sell a fixed portion to qualified manufacturers at controlled pricing, with the remainder sold to investors at market pricing. That creates a two-tier system instantly. Industrial silver may be priced lower, investment silver priced much higher. Investors still pay because access becomes the product. This keeps factories running, but officially stamps silver as a rationed strategic material, which ironically fuels even more investor demand. Path 3, the most likely and the most dangerous. The government tries to manage with warnings and temporary halts, but avoids hard controls to prevent capital flight and loss of confidence. So the panic runs, buying continues, factories keep shifting to bars, dealers keep defaulting, premiums keep stretching, and then after weeks or months, the retail frenzy burns itself out. Prices dip, funds premiums compress, the media calls it a bubble, but the industrial shortage never got fixed. The deficits remain, export restrictions remain. So months later, the next rally starts, driven not by retail emotion, but by industrial desperation, and industrial buyers have deeper pockets than retail ever will. All three paths point to higher long-term prices. The question is volatility, and based on fund halts, factory pivots, dealer defaults, and task forces, it looks like we're on path 3 right now, managed panic, no hard stop, which means the panic continues until it exhausts itself. But the supply crisis remains underneath it. Now, for those of you who want faster updates, the original script mentions a WhatsApp channel. Here's the chill guy version. If you want rapid updates when new data drops, check the links in the description or pinned comment and make sure notifications are on so you don't get this story a week late. And if you want deeper dives, more frequent, shorter updates with extra details, the script also references membership. So if that's your style, you'll find it where it belongs, in the description. Now let me show you the final data point that ties it all together and explains why the panic looks crazy, but isn't. If you only watch headlines, this looks like mania. A fund trading 62% above assets, jewelry factories retooling, hundreds of buyers waiting outside a dealer office. That sounds like a bubble, but there's one number that explains the behavior: China's silver consumption as a share of global supply. In 2023, China consumed roughly 450 million ounces of silver, industrial, jewelry, and investment combined. Global mine production was about 820 million ounces, so China consumed around 55% of global mine output. And if Chinese demand grows fast while mine production grows slowly, you end up with a moment where China's needs swallow the available market. If that trajectory continues, the world gets forced into recycling and inventory drawdowns, and inventories have already been drained by 5 straight years of deficits. So what you're seeing isn't people losing their minds. It's investors and manufacturers looking at the direction of supply and deciding own it now or try to buy it later when it's effectively unavailable. And that's the part Western investors keep missing. If you're anchored to old prices, you'll call $71 expensive because it used to be $20. But supply-demand dynamics have changed. China's export controls that went live January 1st are projected to remove massive tonnage from global trade. And when that reality fully hits, when manufacturers across the US, Europe, India, Japan start getting delivery delays, the price doesn't just spike. It resets into sustained triple digits because there's no fast supply response. Mines can't scale in under 5 to 7 years. Recycling can't close the gap. And China isn't reversing strategic export controls once they tighten. So when you see the fund halts, the factory pivots, the defaults, and the task forces, understand what it really is. It's the early stage of a supply crisis that reshapes the global silver market. Some buyers might overpay short-term and get punished when premiums compress. But over a longer horizon, the bigger risk is being unpositioned in a world where industrial demand presses against total supply. This is not investment advice. This is not a recommendation to buy anything. This is documentation of a market structure cracking in real time. And the real question isn't whether Chinese investors are rational. The real question is whether you understand why they're panicking and whether the same logic eventually reaches your market too. Because if your country depends on imported refined silver, if your industry needs silver to operate, if you see precious metals as protection against currency instability, then what's happening in China isn't their problem. It's the early version of your problem. It just hasn't arrived yet. And when it does, when Western premiums start behaving like Shanghai, when dealers start going silent, when delivery delays appear, positioning will be harder, more expensive, and in some cases impossible. The people who act while markets still look calm, while premiums still look reasonable, while dealers still answer phones, those are the people who stay solvent when the crisis goes global. And based on what's happening in China right now, global doesn't feel like a distant possibility. It feels like a countdown. So